Under the current regulation in Thailand, foreign-sourced income was taxable in the hands of Thai taxpayers only if it is received and remitted to Thailand within the same calendar year. But that is about to change, and in today's video we are going to talk about what are the newest changes in Thai tax system and how that might affect many expats that were previously benefit from remittance-based tax system in Thailand. Hello, I'm Jovana, Director of Business Development here at Nomad Capitalist, where we help 7- and 8-figure entrepreneurs and their families go where they are treated the best. And for many of them, that was Thailand. They loved Thai lifestyle, and obviously, tax system there was very beneficial for those receiving foreign income. As we said, if you're receiving a foreign income and remitting that income to Thailand within the different years, that income was not taxable. But Thailand recently came and said, we're putting an end to this. So what they want to do now is they want to tax every foreign income remitted to Thailand, no matter the year when that income is remitted. And by foreign income, they're referring to any income coming from employment abroad, any income coming from your business abroad, or from the sales of your assets abroad that is remitted to Thailand. But luckily, not everything is that negative. So there are still ways to structure it in a very tax-efficient ways. Today, we're going to go through some of the rules and reading through tax authority explanation why they want to do it and how will this be applicable. So the important thing to know is that these rules are going to apply from the next year, so 2024. So you basically have really short period of time to structure your affairs in a way that will be tax efficient in Thailand. So on a 2025, when you file your taxes in Thailand, these new rules will be applied. So Thai will try to tax everything that you remit to Thailand within the same year. Obviously, for the income that is earned this year and that you remitted next year, those rules won't be applicable. So basically for earnings of this year, they are safe for now. Also, what is important is to notice that they're mentioning only income. So only active income that you generated from your business, from doing a work abroad, or from the sales of your assets. So that does not include savings. So technically, it would be possible to transfer your savings from your foreign bank accounts, no matter what was the maturity period, to transfer into Thailand, and those should not be taxable. Again, the burden of demonstrating that those are savings is on you as a Thai taxpayer. So tax authorities might try to claim that is not actually a saving, that is an active income or an income coming from somewhere that should be taxed. But again, if you have certain savings in a different account sitting there for a long time already, you can transfer those in Thailand even this year and then use those funds through the next period. So savings should technically not be taxable. Again, it is a bit tricky demonstrating that those are, and you will need to have all the supporting documents in case tax authorities might try to audit you. Which is also very interesting given the tax authorities in Thailand were usually not trying to audit tax residents who are foreigners. So they're really focused on local population. And many think that will stay the same, or that they still don't have sufficient personnel to also go and do audits on foreigners and have enough details to do those things. There were some occasions where they were doing audits to foreigners, and those are situations where foreigner would claim a tax credit. In this case, Thai tax authorities will go ahead and do the audit. So at least for the next year, we expect that rule stays the same pretty much. That is informal rules, so it doesn't mean that is always and in every situation true, but we do expect that Thai tax authorities give itself a year, maybe even 2 to 3 years to catch up with this new regulation. So currently only foreigners that are Thai tax residents, but they were claiming some tax credits, had the possibility to be audited, not anyone else. But again, the burden, if they come to auditing, is for you to demonstrate that that income is savings, or that income is not remitted in the same, that was not remitted in the same year. Again, the rule that no longer applies. So you need to keep all the documents very properly and make sure that you can pass that audit. Also, the facilitating circumstances is something that we think will change at some point, because many people are using it, is that tax authorities cannot really know even if you transfer funds into Thai bank accounts. And the reason for that is because Thai banks do not report to Thai tax authorities the status of foreign bank accounts or even domestic and taxpayers and so on. So that is currently in place. So Thai tax authorities really, as I said, don't have a capacity to do the proper audit. But we expect that this rule will slowly change as the Thai tax authorities become more bullish on foreigners, which we see now happening with this regulation. Probably they will issue some additional things. So they might start looking into banks and bank accounts really to know whether the income is remitted or not. Again, in case of an audit, obviously they will go ahead and ask from banks to deliver your statements. So this is, again, the burden of proving that you did not do it. It's on you. We really want to, highlight that just transferring funds from abroad to your Thai bank account with those rules and hoping that they won't audit you, and pretty much using this loophole in which Thai tax authorities are now, that is not legal, and this should not be done. Obviously, many people will still use it, but it is your own, in this case, responsibility to prove and deal with tax authorities that demonstrate otherwise. So again, this is a facilitating circumstances, and it will be for many people. We advise you not to do that, and not, quote unquote, hide those funds and that you remitted those funds, because in the next couple of years, we're absolutely certain that Thai tax authorities will tighten the regulation around this. Also, the good thing is that double taxation agreements will still apply. Thai does have a significant number of double taxation agreements. So if you're, if by double taxation agreements, your foreign sourced income was already taxed somewhere else, you're good to go. You can remit that income to Thailand. Or if there is no double taxation agreement between those two countries, you can still claim some tax credit if you paid certain taxes on that income. Again, claiming tax credit really improves your possibility of being audited by Thai tax authorities. So though this development is not positive, it's not all of that negative. So there are still ways to structure this in a very proper way that won't be taxed in Thailand under 30% rate. So Thailand generally has a progressive tax rate, but most of taxpayers are taxed on 30% tax rate. So there are still ways to structure it. Though these developments are not positive, and we expect to see more and more countries trying this kind of initiatives, so putting them upon on foreign taxpayer. Costa Rica might be one of them. Their president recently vetoed the law that basically says that all foreign income received in Costa Rica will be taxed. Brazil is also thinking about taxing foreign companies. So more and more countries will introduce this kind of legislative in their system. There are still ways to structure it, but obviously you need to be very careful the way you're doing it. So you can benefit from, basically playing with your savings. Obviously, if you do not remit that income to Thailand, that is not going to be taxable. Many people are using their foreign bank accounts for regular purchases in Thailand. Obviously, if you sell your assets offshore and you want to use those to purchase a condo, anything else crucial in big in Thailand, that might be taxable. So watch out about those. Again, structuring in a different way is possible. So if you're still concerned about these new Thai tax changes and not sure how to structure it properly, the Nomad Capitalist team can help you structure your finances and make a plan and implement the plan that will 100% fulfill your goals.